Hey guys, so now we're going to talk about risk to reward ratio and what exactly this all entails. Okay, so for example, just to give you a little bit of context, what risk to reward ratio is, how much are you willing to risk in order to make a potential reward? So for example, if you want to risk $1 to make 2, that is a 1 to 2 risk to reward ratio. Like I said in the introduction video, a lot of people advocate a minimum of 1 to 2 risk to reward ratio. So ideally risking $1 to make 2. However, that is not necessarily the case. It really all depends on the strategy you employ. So for example, in this chart here, we see a potential reversal signal as we see a nice pin bar form here. We'll go into the meanings of different candles and what pin bars are and all that in a later section. However, for the purpose of analyzing risk to reward ratio, we see a pin bar, which is a typical shorting opportunity on a pullback, which we identified over here as the entry after pin bar was printed, and a stop loss right above the high of the pin bar. So in essence, where you got in and where you place your stop loss is your risk. So you're telling the market that if you got in short here and placed a stop right over here at the high, that if the trade went against you, that the market will basically exit the position at a loss at this particular level right over here, and it would do so at it should be at least around 1% equity of your whole trading account. And then your target would be over here, which it would be twice the size of the risk. So this would be a potential a 1 to 2 risk to reward ratio. Okay, so this is used to manage risk and create a mathematical system designed to make money, and we'll show you how to do this. And so really at the end, it really depends on the type of strategy you employ. You may want to use a 1 to 2 risk to reward ratio. However, the more reward you are willing, the more reward you are asking for, the less you'll need to be right. So for example, if you employ a 1 to 2 risk to reward ratio, you need to be right less often than a 1 to 1 risk to reward ratio. Okay, so we'll go into now a different systems, and actually these are real life systems that people are actually using. If you go to myfxbook.com, there are plenty of professional traders that are actually publishing their live results, and I just took one over here that has a more or less a 1 to 1 risk to reward ratio, as we can see over here as the average win and the average loss. You know, average win is $165 and average loss is $130. So it's more or less almost a 1 to 1 risk to reward ratio. Now this is, like I said, a real life trading account on myfxbook.com with 2 years of data. And he has a win ratio of 69%. Right? So at the end of the day, you can see over the span of 2 years, he's been employing a 1 to 1 risk to reward ratio, and he's been profitable. Right? He has increased his account by almost 800% in 2 years. So this is basically a 1 to 1 system. Now, here's another trader that is very profitable as well, has over a year and a half worth of data, with an average win of $104 and an average loss of $426. Now, seeing that his average R to R is actually less than 1 to 1, it's actually more like 1 to 0.25. Now, provided that he has more of a riskier model, right? Because if you have an average 1 to 1, your model is a lot less riskier than something that is an average of 1 to 0.25. So in essence, in order to compensate for this added risk, you have to be right a lot more often. So, and hence the reason, look, if you look at his probability of his trades, it's actually closer to 90% right. And so if you, it also shows if your longs 1, 89%, shorts 1, 95%. So he has a very high win ratio, and this is what you need to do if you want basically take trades that are a little bit more riskier, and then actually have a potential of less of a 1-to-1 risk to reward ratio. Now this trader in particular, I just wanted to briefly mention that what he does is he takes a more of a fundamental approach to his day trading style. And in essence, what this means is he knows that that the euro is in a really bearish correction mode right now. So he's only shorting euro. So if, for example, if he short the euro and then the euro starts to go up, then he may wait a few days or a few weeks to see if the euro will go back down to his original level. And so he applies a fundamental strategy to his day trading strategy. So in essence, what he has allowed to do is, in reality, keep his losers on because of his fundamental approach to his trading strategy. And by doing this, he has averaged a R to R of 1 to 0.25 and has such a high win ratio of 90%. This type of trading style I don't really recommend for beginners, as this involves a little bit more in-depth knowledge of what you want to do because you're also incorporating fundamental analysis and you're taking a lot more risk. As we can see, his drawdown is actually pretty low. It's actually at 13%. And however, if you want to do something like this, I suggest really using really small lots, just in case if you have one particular trade that really goes back, and you don't want to really be, have a trade that's a potential loser, and that you're gonna have to, cut it off because it's such a huge loser. So you want to avoid that as much as possible. So aiming for at least a 1-to-1 ideally at the beginning is what you want to do, and something you should be aiming for as a minimum, at least when you start, for sure. So let's move on into another slide here. Now here's another strategy where this trader is implementing a risk to reward ratio of greater than 1-to-1. Actually, this one is a 1 to almost 2. A 1 to 1.81. So it's a little bit better average R to R than the other two that we saw. This one has 8 months of data with an average win of $21 and an average loss of $11. So now seeing this, we can definitely see that this trader has been consistently profitable for the past 8 months, as he has gained his account over 150%. Now we can also see that his profitability, the probability of his winning trades is a lot lower than the other two, 41%. So this goes to, in essence, to what I was saying before, that the higher the average R to R that you maintain, the less you need to be right? So at the end of this, lesson number 1, we'll put all these statistics together and really design a system that is mathematically sure that you will make money at the end of the day, provided that you keep all your statistics in line and then you don't break your own rules, right? So this is pretty much the end of risk to reward ratio, and we'll move on to another section.